Hello students, hope all of you are fine and doing well during this COVID crisis. Today in this present lecture session, I am going to discuss about aggregates of national income. Already I have discussed few aggregates of national income in yesterday's classes, but today I am going to discuss about few aggregates which have not been discussed earlier. So let us begin. At the starting, I would like to talk about private income. Private income consists of factor incomes earned within the domestic territory and abroad by private enterprises and workers, and current transfers from the government and rest of the world. It includes both earned income and unearned income received by private sector. It means it consists of two kinds of income, that is factor income, which may be called earned income, and transfer income, as we know, that is unearned income. Generally, factor income for the private sector is received from two sources: income earned within the domestic territory, which is known as income from domestic product accruing to private sector, and secondly, income earned outside the domestic territory, which is known as net factor income from abroad, that is NFIA. And in transfer income is received from the two sources mainly. Firstly, income received within the domestic territory, and secondly, income received from outside the domestic territory, which we can say net current transfers from the rest of the world. I hope you could follow the concept. You can see on the screen that the formula I have written: private income is equal to personal income plus corporate tax plus retained earnings. Let us move to the next aggregate. Now I am going to talk about personal income. The concept is quite simple. Personal income is defined as the sum total of the current income of persons or households that are actually received from all the sources like private income, and it also includes both factor incomes and transfer incomes. One thing we have to remember, that personal income does not include corporate tax or profit tax, because such taxes are paid by the private enterprises to the government, and they are not received by the households. And it does not include retained earnings also, because they are retained by private enterprises for their future expansion and unforeseen events. Therefore, on the PPT slide you can see I have written the formula of personal income like this: personal income is equal to private income minus corporate tax minus retained earnings. Okay, let us move to the next slide. Now let us discuss what is personal disposable income, or in short PDI. Personal disposable income refers to that part of personal income which is actually available at the disposal of households. I mean, it is either spent on consumption or saved by the households. Actually, it is that part of personal income which is left with the households after making of taxes, fees, and other miscellaneous receipts of the government. That is why on the PPT slide, the PDI formula is written as PDI is equal to personal income minus personal taxes minus miscellaneous receipts of government. Okay. There is another important concept which I would like to discuss in this class, that is national disposable income. So let me change the slide. So here it is, national disposable income, NDI in short. Now what is national disposable income? NDI is the income from all sources available to the residents of a country for disposal. Basically, it includes both factor income and transfer income. It is also known as net national disposable income. The national disposable income includes net indirect taxes, as it is the transfer income of the government and is free to use it the way it likes. Okay. And it also includes net current transfers from ROW, I mean rest of the world, and as it is the transfer income of the government received from abroad. So the formula of this becomes national consumption expenditure plus national savings. With this, we came to the end of this present lecture session. If you have any question, please post to me. Thank you so much.